Hello students, today we discuss about 9 topic related to cost accounting. Okay, what is cost? Cost can be simply defined as the money or resources associated with a purchase or any other activity. So different industries adopt different methods of ascertaining cost of their product. Depends on the nature of the production and the type of product. Okay, so here we discuss the types of costing, the 9 important topic: marginal costing, standard costing, process costing and activity based costing, life cycle costing, target costing and KAIZEN costing, JIT, just in time, and also we discuss break-even analysis. Okay, so let's go. First we discuss marginal costing. Marginal cost is the additional cost or extra expense. Okay, so it is an additional cost of producing an additional unit of product. Okay, what is marginal costing? It is the additional cost of producing an additional unit of product. It is also known as variable cost. Total cost minus fixed cost, we get the variable cost. Okay, for example, the total cost of producing 1 pen is rupees 5, and then total cost of producing 2 pen is rupees 9, then marginal cost of expanding output. So here total cost of producing 2 pen, that is the additional production. We need the additional cost, that is 9. So our marginal cost is 9 minus 5 equal to 4. Okay, so marginal cost of expanding output by 1 unit is 4. Okay, this is marginal costing. So marginal costing is the additional cost or extra expense of producing an additional product. Okay, it is also known as variable cost. Next one, standard costing. It is an important subtopic of cost accounting. Standard costs are usually associated with a manufacturing company. Cost of direct material, direct labor and overhead. Okay, then here it is a predetermined cost which is prepared for each cost of unit. Then it is an important term, that is a variance. It is related to standard costing. So difference between actual cost and standard cost is known as variance. Difference between actual cost and a standard cost. If actual cost greater than standard cost, variance is unfavorable. Then if actual cost less than standard cost, the variance is favorable. Okay. Then another feature of the standard costing, it helps to take an appropriate action. For example, when considering labor hours, it's a downtime from production due to maintenance or startup and break time must included in the number of hours it takes to make a product. Once standards are established, they are used to analyze and determine for actual cost variance from standard. The variance may be quantity of material or hour used to manufacturing a product. Okay, so standard cost, it's very helpful in preparing budgets. Analysis of variance can be used to provide management information about whether a variance is caused by quantity or price, so that appropriate action can be taken with the help of the predetermined cost. That means the variance analysis. Okay, that is standard costing. Standard costing is a predetermined cost. Okay, if a standard is fixed, it can be combined to the actual cost, then find a variance. Variance is unfavorable or favorable. Okay, on the basis of this information, management can take an appropriate action. That is a standard costing. Okay. Next one is process costing. It is used when there is a mass production of similar product. Process costing is used when there is a mass production of similar products. Okay, they continuously process their product, moving it from one function to next until it is completed. In these companies, the manufacturing cost incurred are allocated to the proper function or department within the factory process rather than to specific product. For example, the product that companies produce continuously are bread, automotive parts, chips and computers, and also provide services such as mail sorting and catalog order is an example of continuous or homogeneous processing. So process costing is mainly focusing on it is used when there is a mass production of similar product, and also it's continuously process from one function to another until it is completed. Okay, next one, activity based costing. It is an accounting method to find out the total cost of activities necessary to make a product. To use activity based costing, you must understand the process of assigning cost to activities. Okay. First one, identify which activities are necessary to create a product. Each activity has its own cost pool. So determine the total overhead of each cost pool. For example, purchasing could be its own cost pool. And next one, assign cost drive to cost pool. Okay, cost pool drivers are things unit, hours, part, etc. For example, purchasing costs are driven by the number of parts purchased. Okay, then divide the total overhead by the total cost driver. You get an cost driver rate. Okay, then lastly, compute how many hours or part that the activity is used. Multiply it by the cost driver rate. Okay. This table focused on different activities and their cost drivers. In case of production, what's the cost drivers? Number of units, number of setup, number of electricity units consumed, and number of hours spent in production. Then in case of marketing, cost drivers are number of sales personnel, number of sales order. Then research and development. Cost drivers are number of research project, personal hours spent on project, and technical complexities of the project. Then in case of customer service, cost drivers are number of service calls, number of products serviced, and hours spent on servicing product. Then in case of purchasing, number of purchase order. Then material handling, cost driver is number of material requisites. Okay, let's see an example. Question: how much you are spending on utilities to create a product? To do this, utility 3 hours. Estimate that your total utility is 20,000 for the year. You determine that the cost driver impacting your utility bill is the number of direct labor hours worked. The number of direct labor hours worked total 1,000 hours for the year. So first you have to identify the activities which is necessary to create a product. So the activity is total utility, that is 20,000. Then identify the cost driver. And here in this question the activity is a production. Okay, what are the cost drivers of the activity of production? Number of units, number of setup, number of electricity units consumed, number of hours spent in production. In this question, the cost driver is number of the labor hours spent in production. Okay, so our cost driver is number of direct labor hours, that is 1,000. Then third stage, divide the total utility by cost driver. That is 20,000 divided 1,000. 20 hours. This is the cost driver rate. Okay. Then finally compute how many hours that the activity used. For this particular product, you used a utility for 3 hours. So multiply the hours by the cost driver rate. That is 20 into 3, 60. Okay. Next one, life cycle costing. Life cycle costing or whole life costing is the process of estimating how much money, okay, how much money you will spend on asset over the course of its useful life. Okay, estimating how much money you will spend on an asset over the course of its useful life. Okay, buying an asset is a cost commitment that extends beyond price tag. For example, when purchasing a car, you also need to consider expense for car, insurance, oil charges, and any other necessary maintenance to keep car running. Okay, so you purchase whether a car or computer or any other type of inventory, you should consider and budget for the asset future cost. That is life cycle costing. Okay, it's mainly focusing on estimation, estimating how much money you will spend on an asset over the course of its useful life. That is life cycle costing. Okay. Next one, target costing. It is considered one of the most important tools for achieving consistent profitability in a manufacturing environment. Under this method, a company plan in advance for the price point, product cost and margin to achieve for a new product. It continually monitoring the product from one moment they enter the design phase and onward throughout their product life cycle. That is why target costing is an excellent tool of planning a suite of product that have high level of profitability. Equation of target costing equal to selling price minus profit margin. Okay, target costing equal to selling price minus profit margin. So let's see an example. FMCG players that operate in very competitive market. It sells packaged food to end customers. They can only charge rupees 20 per unit. If the company intended profit margin is 10% on the selling price, calculate the target cost per unit. Okay. So target cost equal to selling price minus profit margin. Here the selling price 20 per unit. Okay, and profit margin that is 10% on the selling price. Okay, 10% on 20 that is 2. So target cost equal to 20 minus 2, 18 per unit. Okay. Next costing, Kaizen costing. Okay, the word Kaizen is a Japanese word which means continuous improvement. It is a cost reduction system. In simple words, it is a practical approach to solving cost related problem to improve the overall efficiency of the organization. Then the major difference between target and Kaizen costing, that is, a target costing, it can be applied during the design stage of the product, whereas Kaizen costing is applied during the manufacturing stage of the product. Okay, so Kaizen costing means continuous improvement. Okay, it's a cost reduction system and it can be applied during the manufacturing stage. Okay. Next one, JIT. It stands for just in time. It is an inventory management method whereby materials, goods and labors are scheduled to arrive or be refilled exactly when needed in the production process. Okay, and this method reduces cost by minimizing warehouse needs. Okay, cut inventory cost. That means manufacturer do not have to pay storage cost. Okay, so JIT production system cut inventory cost because manufacturing do not have to pay storage cost. Okay, and then also it minimize the warehouse needs, which means that the manufacturer can quickly move from one product to another. Okay, then also companies also spend less money on raw material because they buy just enough resource to make the ordered production and no more. For example, a car manufacturer that operates with a low inventory level but heavy relies on its supply chain to deliver the parts. It required to build a car as needed basis. Consequently, the manufacturer orders the parts required to assemble the car only after an order is received. Only after an order is received. So just in time, JIT stands for just in time. Okay, it's an inventory management technique. It can reduce cost by minimizing warehouse needs, and also they spend less money on raw material. Okay, that is just in time. Next one, break-even analysis. It's an important term in cost accounting. Break-even analysis, it's a financial tool which helps to determine at what stage your company or a new service or a product will be profitable. Here the term BEP, it stands for break-even point, is the point at which total cost and total revenue are equal. That means there is neither profit or loss. No profit or no loss. Okay. This is a simple statement of marginal cost. Sales less variable cost contribution, less fixed cost profit. How to calculate contribution? Sales minus variable cost contribution. Then less fixed cost contribution minus fixed cost equal to profit. Okay. Then another equations are PV ratio. PV ratio equal to contribution divided by sales into 100. How to calculate contribution? Sales minus variable cost. Then also break-even point in unit and sales. In unit equation, fixed cost divided by contribution. In sales, fixed cost divided by contribution into total sales. And also fixed cost divided by PV ratio. Then margin of safety, it is a difference between actual sales and break-even sales, or profit divided by PV ratio. Another one, number of units to be sold to earn desired profit. Calculate number of units to be sold to earn desired profit equal to total fixed cost plus desired profit divided by contributions per unit. Then calculate the sales value required to earn desired profit equal to total fixed cost plus desired profit divided by PV ratio. Okay, an example. From the above table, calculate PV ratio, BEP in units, BEP in sales, then margin of safety, MOS. Calculate profit if sales value is rupees 20,000. This is a simple statement of marginal cost. Okay, sales less variable cost, that means 10,000 minus 6,000, 4,000 contribution. Less fixed cost to 3,000, that means profit 1,000. Okay, then let's see how to calculate these 5 terms. Okay, the first one, PV ratio. Equation of PV ratio, contribution divided by sales into 100. Here contribution 4,000 divided by sales 10,000 into 100. So PV ratio equal to 40%. Okay. Then BEP in units. Equation fixed cost divided by contribution. Okay, 100 in units. Okay, fixed cost divided by contribution. Here fixed cost 3,000 divided by contribution 4,000. 3,000 divided by 4,000 in 100 units. That means 75 units. Then in sales, already we calculate PV ratio. So this formula we can apply. Okay, BEP in sales equal to fixed cost divided by PV ratio. Okay, fixed cost 3,000 divided by PV ratio 40%. So BEP sales value 7,500. We can check, we can verify this because break-even point is a no profit or no loss. Okay, so we can verify this answer is correct or incorrect on the basis of the BEP point. Okay, let's see. Okay, verification. BEP units 75 units. Okay, sales, BEP sales 7,500. Okay, 100 into 75. Less variable cost 60 into 75, that is 4,500. Okay, then contribution equal to 3,000. Less fixed cost 3,000. So profit nil. That is break-even point, there is a no profit or no loss. Okay. The next one, margin of safety. It can be calculated with these two formula. First one, margin of safety equal to actual sales minus BEP sales. Here actual sales is 10,000. Okay, minus break-even sales. Break-even sales already we find out 7,500. So our margin of safety equal to 2,500. And also another equation, profit divided by PV ratio. Okay, here profit is 1000 divided by PV ratio 40%. Okay, same answer 2500. Okay, these two equations can be applied. Margin of safety, actual sales minus break-even sales, or profit divided by PV ratio. Then the last one, calculate profit if sales value 20,000. Okay, here sales value is given. So these equations can be applied. Sales value required to earn desired profit equal to total fixed cost plus desired profit divided by PV ratio. Here sales value, that is 20,000, and fixed cost 3,000 plus profit we have to find out, then divide by 40%, that is PV ratio. Okay, then cross multiply 20,000 into 40%, 8,000 equal to 3,000 plus profit. So here profit equal to 5,000. Okay. Okay, in this video we discuss about what you mean by the cost and different types of costing. Marginal costing. Marginal costing, it is an additional cost or a extra expense costing. Okay, producing an additional unit of product. Then standard cost, it is a predetermined cost, and here the variance is the important term related to standard costing. And process costing, it is a continuously process, and you have to find out the mass production of the similar product. Okay, then activity based costing can be find out with the different stages on the basis of the cost drivers with an example. And life cycle cost, it's an estimating how much money you will spend on an asset over the course of its useful life. And target costing, it's a continually monitoring the product. Okay, company plan in advance. Target costing equation, selling price minus profit margin. Then KAIZEN costing is a continuous improvement, okay, during the manufacturing stage of product. And JIT, just in time, to reduce inventory cost by minimizing warehouse needs, and also they spend less money on raw material. And break-even analysis, an important term, there is a no profit or no loss. Okay, then different equations with the example. Okay, so prepare well. Thank you.